Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings so you don't have to. Today, we're looking at a report from Viridian Therapeutics. Prepare for a bit of financial maneuvering that might leave you wondering, are they raising money or running a marathon? Let's find out. Viridian filed this report because of something that happened on March 3, 2025. This is an 8K filing, which companies use to announce major events that could affect their stock price. The big news here is that Viridian entered into an agreement to sell shares of its stock. They're teaming up with Jefferies LLC, who will act as the sales agent. In plain English, Viridian is planning to offer shares of its common stock. How much stock are they planning to sell? Up to $300 million worth. It's a substantial amount, and it tells us Viridian needs a significant injection of cash. So, why do they need the money? According to the report, they want to use the funds to continue developing their drugs. This includes pushing forward the clinical trials and getting ready to sell any drugs that are approved, especially one called Veligrotug. They also want to use the money for general business needs. Basically, it's all about funding their growth plans. To make this stock sale happen, Viridian is using something called a shelf registration statement. Think of it like having permission from the SEC to sell shares whenever they need to without having to ask every single time. The sales agent, Jefferies, will try to sell the shares when Viridian tells them to. Viridian will have to provide Jefferies with standard protection and contribution rights. For their efforts, Jefferies will get a commission. They get up to 3% of whatever they make selling the stock. The shares might be sold privately in large chunks or through the stock market. But Viridian doesn't have to sell any shares if they don't want to and can stop the sales at any time. The agreement ends if all the shares are sold, or if either Viridian or Jefferies decides to end it with 10 days' notice. If you want to read the agreement in detail, it's available as an exhibit to this report. There's also a legal opinion about these shares being offered, which you can find as another exhibit. This report isn't an offer to sell shares, it is only an announcement. They can't sell the shares in any state or country where it's illegal to do so. Here's a twist in the story. Remember that previous agreement Viridian had to sell stock, the one from September 2022, they're ending it. That earlier agreement was for selling up to $175 million in stock. They ended the deal with the sales agent. That means their previous stock offering is also over. Under the old agreement, they sold $115.2 million worth of shares. They won't be selling any more stock under that agreement. Ending the previous agreement won't cost them anything. Finally, the report lists all the documents attached as exhibits like the sales agreement and legal opinions. So what's the big picture here? Viridian is raising a significant amount of money, $300 million, by selling shares. This is a common move for biotech companies that need cash to fund expensive drug development programs. The fact that they terminated a prior agreement and are now seeking even more capital could suggest a few things. Maybe their development costs have increased, or perhaps they see a promising opportunity to accelerate their programs. On one hand, raising this much money dilutes the value of existing shares. That's generally not great news for current investors in the short term. On the other hand, if Viridian is successful in developing and commercializing its drugs, particularly Veligrotug, this investment could pay off handsomely in the long run. The termination of the previous sales agreement also raises some questions. Why end one agreement and start another, especially one that aims to raise almost twice as much money? Was the previous agreement not working out as planned? Are they confident that the new agreement will be more successful? Viridian is clearly betting big on its future. They're investing heavily in their product pipeline, and they're willing to take on some short-term pain to potentially achieve long-term gain. The key will be whether they can successfully navigate the complex and risky world of drug development and bring their products to market. Viridian is clearly in growth mode, aggressively seeking capital to fuel its ambitions. While there are risks involved, such as potential drug development setbacks and market competition, the potential rewards are substantial. Their success hinges on efficient capital management, successful clinical trials, and a favorable regulatory environment. In conclusion, Viridian's latest move is a bold one, signaling strong growth ambitions and a high-stakes gamble on its drug development pipeline. Whether this gamble pays off remains to be seen, but it certainly makes for an interesting story to follow. Thanks for tuning in to Corporate Decoder. If you found this analysis helpful, give us a like, drop a comment, and subscribe for more deep dives into the world of corporate filings. What are your thoughts on Viridian's strategy? Let us know in the comments below.